That is the number that pushed gold to $4,600 overnight and sent silver surging back above $74 this morning. 99% of people watching the charts right now have absolutely no idea why. The US just delivered Iran a 15-point peace framework transmitted through Pakistan, confirmed by the New York Times, Reuters, Bloomberg, the Wall Street Journal, and Arabiya, all within hours of each other. The plan targets Iran's nuclear program, its ballistic missiles, its proxy financing network, and the Strait of Hormuz. Trump stood in the Oval Office yesterday and said, and these are his words, "They want to make a deal so badly. You have no idea how badly they want to make a deal." And Iran, for the first time since this war started on February 28th, quietly told the International Maritime Organization that non-hostile vessels may now pass through the Strait of Hormuz. The market heard all of that. Gold heard it. Silver heard it. And the physical buyers who have been waiting on the sidelines while the paper market was hammering prices for 3 weeks, they heard it loudest of all. But here is what nobody on financial television is explaining to you today. The Iran peace deal is not the only story. It is not even the most important story. The Iran deal is a match. The COMEX vault data is the gasoline. Because while traders were watching geopolitical headlines, while the S&P was surging, while oil was reversing, the COMEX silver registered inventory number has been quietly falling off a cliff. And today, as of March 25th, 2026, that number is sitting at levels that make a physical delivery failure. Not a theory, not a prediction, not a worst-case scenario. It makes it math. I'm going to show you both stories today. The geopolitical surface that everyone is watching, and the physical foundation underneath it that almost nobody is reading, because the combination of those two things is what creates the setup for the next major move in silver. I'm OG. Subscribe. Let's get into it. Segment 1, the 15-point deal. What it says and what it means for silver. Let me walk you through what actually happened in the last 48 hours, because the headlines are scattered and the sequence matters. The war between the US, Israel, and Iran began on February 28th. Since then, Iranian strikes have hit Israel, Kuwait, Bahrain, and Saudi Arabia. The Strait of Hormuz has been largely blockaded, which means roughly 1/5 of the world's daily oil supply has been at risk every single day. Brent crude spiked. Inflation expectations surged. The Fed held rates at 3.5% to 3.75% and signaled it was not cutting. The dollar strengthened, and silver, which was near $117 before the war started, got absolutely crushed, bottoming near $61 at its worst point. That was the macro environment going into this week. Then on Monday, Trump signaled publicly that talks were underway. By Tuesday, he was in the Oval Office saying Iran had agreed to never pursue nuclear weapons. The framework was confirmed through multiple channels. The New York Times, Reuters, Bloomberg confirmed the framework had been physically transmitted to Iran via Pakistan, with Pakistani Army Chief Field Marshal Saim Munir serving as the key intermediary. Egypt and Turkey are also pushing Iran to engage. The deal asks Iran to dismantle its 3 main nuclear facilities, end enrichment entirely, suspend its ballistic missile program, stop financing all proxies, and keep the Strait of Hormuz open as a free maritime zone. In return, Iran gets full sanctions relief, support for civilian nuclear power at Bukur, and removal of the snapback mechanism for reimposing international sanctions. Now, is this deal done? No. Iran's foreign ministry denied direct talks as recently as Monday. Israel is skeptical. Netanyahu is worried Trump will accept terms that fall short of Israeli objectives. Steve Wyckoff told Trump that Iranian officials agreed to surrender their highly enriched uranium stockpile. Iran retains an estimated 440 kilos of it, but American sources openly admit it is too early to say if they have a real viable channel. Here is why none of that uncertainty cancels out the silver move. When the Hormuz blockade lifts, even partially, even for non-hostile vessels, as Iran announced yesterday, the oil risk premium deflates. When the oil risk premium deflates, inflation expectations compress. When inflation expectations compress, the Fed gets room to pivot. When the Fed pivots, real yields fall. When real yields fall, the dollar weakens. And when the dollar weakens, every single bearish argument that has been used to justify the 3-week paper price crash in silver evaporates simultaneously. The institutions that sold silver from $117 down to $61 did it because the war made the Fed hawkish and real yields were rising. A peace deal reverses every variable that made that trade work. Gold already repriced on Tuesday. Gold is trading near $4,550 to $4,600 this morning, recovering from a March low that touched the mid-$4,200. Silver is back above $74, recovering from an intraday low of $66.16 on Tuesday that generated a 5.46% reversal in a single session. The physical market told the paper sellers at $66 there is a floor, and that floor is made of physical buyers, not chart patterns. Segment 2, the vault that has almost nothing left. Now, let me show you the second story. The one that explains why the next major move in silver when it comes will not look like the gradual rally most analysts are modeling. COMEX registered silver, the metal that actually backs futures contracts, the physical delivery pool, the only number that matters when a contract comes due and someone demands real metal. Here's the trajectory. In 2021, COMEX registered silver was above 300 million ounces. By October 2025, it had declined to approximately 167 million ounces. By early February 2026, it had fallen below 90 million ounces. As of this week, the number is sitting near 79 million ounces, down over 80% from its 2021 peak. And the rate of withdrawal is accelerating. Over the past 30 days alone, registered inventory has declined 10.8%. That is 9.66 million ounces pulled from the deliverable pool in a single month. At the current withdrawal pace, analysts tracking this data calculate that registered silver would be exhausted in approximately 182 trading days. Let me put those numbers in context. With the paper market sitting on top of them, current COMEX paper leverage is running at 7.1 times. That means for every single ounce of registered deliverable silver in the vault, there are 7.1 paper claims. The coverage ratio, meaning what percentage of outstanding futures contracts could actually be satisfied with physical metal, stands at 14%. Below 15% is officially stress territory. The COMEX has never navigated a major delivery month with a coverage ratio at these levels while simultaneously facing geopolitical supply shocks. April's first notice day is now 4 business days away. As of now, 1,825 open contracts representing 9.1 million ounces of physical silver are still sitting open with no clear resolution. Those contracts must be settled with real metal or with cash. If even a modest fraction of them stand for delivery rather than rolling forward, the vault math does not work. Now, think about what December told us. In December 2025, COMEX processed 46.635 million ounces of physical silver delivery, representing 50% of the estimated free float registered inventory in a single month. Then January came. January is historically a quiet delivery month. The average delivery in a January is somewhere around 3 to 5 million ounces. In January 2026, the market processed between 33 and 49 million ounces, a 7 to 10 times increase over historical norms. Traders were not rolling contracts forward and waiting. They were demanding the metal immediately. JP Morgan alone issued 99% of 8.1 million ounces in delivery notices on a single day in early January. And despite all of those deliveries, open interest in January actually increased by over 1,200 contracts. New buyers were entering faster than metal was being removed. That metal did not stay in the Western system. It left. It went to London, where silver lease rates had spiked to 34.9%, in a market where a normal annual lease rate is below 1%. It went to Shanghai, where physical silver has been trading at a consistent premium of $5 to $12 above COMEX spot prices. It went to the vaults of institutional buyers across Asia who looked at the paper price, looked at what they knew about physical supply, and decided to take delivery rather than trust a paper settlement. That is the drain. That is where the 80% decline from 2021 went. It was not an accounting change. It was not a reclassification. It left the building, and it is not coming back. Segment 3, what the banks know and the math they are running. Here's the part of this story that the financial media systematically refuses to explain. When COMEX raises margin requirements, as CME Group did on March 19th, the stated justification is always the same, curbing volatility. What actually happens is different. Leveraged traders who were already stretched thin get a margin call within hours. They have a choice. Wire fresh collateral or liquidate. Most of them liquidate into whatever market exists at that moment. The price falls. The financial press describes it as silver correcting to fair value. Nobody asks whether the institution that knew the margin hike was coming also happened to have a large short position that benefited from the forced selling. JP Morgan paid a record $920 million fine to the CFTC for spoofing and manipulation across precious metals and treasury futures, spanning at least 8 years from 2008 to 2016. 2 traders went to federal prison. The head of their global precious metals desk received a conviction. And yet today, estimates place JP Morgan's physical silver stockpile at over 750 million ounces. They accumulated most of it between 2012 and 2019 when silver was stuck between $14 and $20. They built the largest private silver holding since the Hunt brothers while the paper price was being managed. Now the paper price is in the 70s and they hold 750 million ounces of real metal. That is not a contradiction. That is a strategy with a very specific exit. When the paper market raises margins and crashes silver from $87 to $66 in 12 days, the way it did between March 12th and March 19th, who is on the other side of those forced liquidation sales? When physical buyers show up in Singapore at 3 times normal daily volume, who sourced the metal they are buying? When the SLV ETF records $2.15 billion in outflows over 3 months, where does that silver go? The paper mechanism and the physical mechanism are not two sides of the same market. They are two completely separate markets operating at different speeds with different owners, measuring different things. The paper market measures what traders are willing to bet about tomorrow's price. The physical market measures what institutions are willing to pay to own metal today permanently with no counterparty on the other side. When those two markets diverge, and right now they are diverging at a scale that has no precedent in modern silver market history, something eventually resolves the gap. Either the paper price rises to meet physical reality, or the physical market stops accepting paper-based pricing as legitimate. Both outcomes are violent. Segment 4, the numbers that build the case for $100. Let me walk you through the arithmetic on $100 silver because this is not wishful thinking. It is the output of 3 independent calculations that all arrive at the same place. The first is the gold-silver ratio. Gold is trading near $4,550 today. Silver is at $74. That puts the ratio at approximately 61.5 to 1. The historical mean across multiple precious metals, bull cycles, is 40 to 50 to 1. Apply the historical lower bound of 50 to 1. To today's gold price, silver should be at $91. Apply the historical midpoint of 45 to 1. Silver should be at over $101. Nothing exotic needs to happen for these numbers to materialize. The ratio simply returns to where it has historically traded during gold bull markets. Gold does not have to go up. Silver just has to catch up. The second calculation comes from the structural deficit. The cumulative global silver supply deficit since 2021 now stands at approximately 820 million ounces, nearly a full year of total global mine production permanently removed from above-ground supply. The Silver Institute has confirmed the 6th consecutive year of structural deficit in 2026, with global demand running at 1.24 billion ounces against supply of approximately 1.01 billion. That 230 million ounce annual gap does not stop because the paper price went down. Industrial buyers do not adjust their procurement contracts because COMEX had a bad week. Solar panel manufacturers do not redesign their sales because margin calls forced a paper price decline. The factory line that needed silver in February needs silver in March. It will need silver in April. Demand is not negotiable. The third calculation is what Bank of America and Citigroup are projecting from their own research desks. Bank of America put out an official projection of $135 to $139 per ounce for 2026. Citigroup has issued a near-term target of $150. These are not the people on X. These are the research divisions of the largest financial institutions in the world, the same institutions that hold the short positions on the COMEX that collect the fees on the SLV ETF that sit on the CME Group board, when their own research divisions publish $135 and $150 price targets. While the paper market is sitting at $74, you have to ask which number reflects what they actually believe. Keith Neumeyer, founder and CEO of First Majestic Silver, the world's most prominent dedicated silver mining company, stated publicly this week that triple-digit silver will return and that new highs are coming. This is not a chart target. It is an operational read from the CEO of a company that extracts physical silver from the ground every single day. His reference for silver's value is not a futures curve. It is the physical supply chain itself observed from the inside. Segment 5, the bear case presented straight. You came here for a real analysis, so I'm going to give you the full bear case because this channel does not deal in echo chambers. Every argument I cannot refute, honestly, is an argument you need to evaluate for yourself. The strongest bear argument right now comes from Marko Kolanovic, former chief strategist at JP Morgan, who has publicly called the silver rally a meme-driven mania and predicted a retrace back to $50. His argument is that silver's 52-week range of $29 to $121, a 318% swing, reflects speculative excess that historically resolves through violent unwinding. He points to the 1970s when gold surged from $40 to $200, crashed 50%, and eventually ran to $800. His thesis is that silver needs to shake out the last weak hands before the next real leg begins. The March 19th margin hike and the $2.15 billion in SLV outflows over 3 months support his read. Institutional paper money is visibly leaving. ETF flows are deeply negative. The dollar is still firm. The Fed has not pivoted. And even with the 15-point Iran plan on the table, there's no guarantee Iran accepts it. Iran is still launching missiles, including a strike that hit near Buker nuclear power plant on Tuesday, and Israeli operations are ongoing across Lebanon. If the peace process collapses, oil goes back above $120. The dollar strengthens further, and the Fed signals no cuts at all in 2026. Silver could test $60 or lower before finding real support. That is the honest bear case. If you own silver and you cannot sit with that scenario, you need to reconsider your position sizing. But here's what the bears have to reconcile with the physical data. Registered COMEX silver at 79 million ounces is not a paper chart. It is not a sentiment indicator. It is a physical count of metal sitting in specific vaults in New York, audited and published by CME Group every single day. The 80% decline from 2021 did not happen because of a narrative. It happened because people took delivery and moved the metal east to Shanghai, to the SGE, to sovereign vaults that are not returning it. When the paper price fell from $87 to $66 in 12 days, physical demand at Bullion Star in Singapore ran at 3 times normal volume. People in Istanbul were lining up outside dealers in the Grand Bazaar. Chinese banks ran out of small gold bars. Backwardation appeared in Shanghai, meaning buyers were paying a premium to own metal today rather than accept a futures promise for later. Speculative bubbles unwind to selling at the lows. Physical markets respond to lower prices with accelerating buying. Those two behaviors are mutually exclusive. You cannot have both happening simultaneously unless what is being sold on the paper market and what is being bought in the physical market are actually different things. And they increasingly are. Here is where everything stands. As of today, Wednesday, March 25th, 2026, gold is trading near $4,250. Silver is at $74, recovering from an intraday low of $66.16 on Tuesday that produced a 5.46% reversal, driven entirely by physical buyers stepping in across multiple continents simultaneously. The U.S. has sent Iran a 15-point peace framework. Iran has partially opened the Strait of Hormuz to non-hostile vessels. Back-channel negotiations through Pakistan, Egypt, and Turkey are confirmed by multiple major news organizations. Trump says Iran has agreed to never pursue nuclear weapons. The official ceasefire discussions involve a 30-day pause during which the full 15-point framework would be negotiated. If this process advances, every macro headwind that crushed silver for 3 weeks reverses simultaneously. Oil falls, inflation expectations drop, the Fed softens, real yields decline, the dollar weakens. Silver catches a bid from all directions at once. Meanwhile, COMEX registered inventory sits at 79 million ounces. Coverage ratio is 14%. Paper leverage is 7.1 times. April 1st, notice day is 4 business days away with 9.1 million ounces still open. The metal that left the vault over the past 5 years is not coming back from Shanghai. It is not being returned from sovereign reserve vaults. The 820 million ounce cumulative structural deficit since 2021 does not reverse because a futures desk put in a sell order. The paper market is sitting at $74. The physical market is telling you it is worth considerably more. Bank of America says $135. Citigroup says $150. Keith Neumeyer says triple digits within months. The gold-silver ratio at 61.5 to 1 says fair value is above $90 at the historical lower bound, above $100 at the midpoint. The case for $100 silver is not a hope. It is arithmetic waiting for a catalyst. The 15-point Iran peace deal just handed the market its catalyst. The COMEX vault data is the foundation underneath it. If this breakdown gave you a clear picture of both stories, the geopolitical surface and the physical reality underneath, drop a comment below with one word, your price target for silver by end of 2026. One number. I read every single one. Hit subscribe. Turn on notifications. This situation is moving fast. And when the April 1st notice day data drops in 4 business days, I will be here with the full breakdown of exactly what